Assalamualaikum. My name is Siti Nurhayati binti Zainal Abidin. I am going to give an introduction on Bank Muamalat Indonesia that have been chosen by our group. Bank Muamalat Indonesia (BMI) is the first financial institution to offer Sharia banking in Indonesia. Established on November 1 in year 1991, Bank Muamalat Indonesia has been acknowledged by the Indonesia Council of Ulama and Indonesia's government. In May 1992, Bank Muamalat Indonesia officially started their operation. Despite all the challenges that BMI had to face during that period, they still managed to effectively attract foreign investors to become the major stakeholder of Bank Muamalat Indonesia. The foreign investors are Islamic Development Bank, Bopyan Bank, Atwil Holdings Limited, and National Bank of Kuwait. Bank Muamalat Indonesia has extensive coverage in Indonesia with more than 325 network of branches, sub-branches, cash office, and mobile branches all over Indonesia. BMI is the first and the only Indonesian bank that entered in Kuala Lumpur, Malaysia. BMI always do renovation in their products by bringing out Sharia compliance products such as Mudharabah Subordinate Sukuk, Sharia insurance or takaful, and Islamic banks' performance can be looked at by their financial statements. Ratio analysis under Basel III is very important to measure the bank's performance. Ratio analysis is the analysis of various pieces of financial information in the financial statements of a business. Ratio analysis can be used to see the comparison of a company's financial performance to the similar firms in the industry to understand the company's position in the market. Basel III is the third of three Basel Accords, a framework that sets international standards and minimums for bank capital requirements, stress tests, liquidity regulations, and leverage, with the goal of mitigating the risk of bank runs and bank failures. Capital adequacy ratios (CAR) are a measure of the amount of a bank's core capital expressed as a percentage of its risk-weighted asset. The ratio in 2016 is 12.42%. The ratio has increased by nearly 3% in 2020. The year 2020 was marked by COVID-19, so the bank may have adopted a conservative approach to strengthen its resilience against economic. By the year 2021, the capital adequacy ratio had a sharp jump by increasing over 8%, reaching 22.776% in that year. Next, in the year 2022, the ratio has reached its peak, jumping by 9%, making the ratio at that year 32.7%. Lastly, there was a slight decline of 3.28% from 2022, making the ratio by the year 2023 is 29.4%.
Assalamualaikum. My name is Muhammad Hakimi Bosri. Today I will be presenting on the asset quality ratio (AQR), which is an important measure of a bank financial stability and credit risk. This ratio calculates the percentage of non-performing loans compared to total loans. A lower AQR indicates better financial health, while a higher AQR suggests greater credit risk. For Bank Muamalat Indonesia, monitoring AQR is crucial in assessing its asset quality and overall financial stability. The formula used to determine AQR is the non-performing loans divided by total loan multiplied by 100. Looking at the AQR trend of Bank Muamalat Indonesia from 2019 to 2023, we can see a continuous improvement in the asset quality. In 2019, the AQR stood at 5.22%, which reflected a high level of non-performing loan and significant credit risk. By 2020, the ratio slightly improved to 5.06%. If the dark economic challenge persists in 2031, the AQR further decreased to 4.26%, indicating better risk management and financial health. The year 2022 saw a sharp decline to 2.78%, significantly strong credit policy and improved loan performance. Finally, in 2023, the ratio is 11.8%, 2.07%, which reflected excellent asset quality and strong financial stability for Bank Muamalat Indonesia. The steady decline in AQR over the year highlight the bank's ability to manage credit risk effectively. The lower AQR not only signify better financial health but also boost investor confidence and ensuring long-term sustainability. A significant improvement from 2019 and 2023 indicate that the bank has successfully enhanced in loan portfolio and reduced to exposure non-performing.
Ratio can be expressed in percentage, and the higher the percentage is, the better. The ratio for 2019 is 0.05%, shows a positive ratio. Next, the ratio is in 2020 is 0.03%, which has slightly declined from 2019. The ratio in 2021 is 0.02%. Next is in the year 2022. The bank had an increase in the ratio, which is 0.09%, showing the improvement in profitability and their efficiency. Lastly, in 2023, the ratio fell back at 0.0. Ratio can be described as a financial ratio that helps measure a company's proficiency to generate profits from its shareholders' investments. The formula is net income per average total equity. For 2019, the ratio is 0.545%. It is a positive ratio, but a modest one. For the year 2020, the return of equity ratio is 0.29%. The ratio declined from 0.45% to 0.29%. In 2021, the ratio is 0.20%, which has dropped further to the lowest level in the 5 years. By the year 2022, the ratio is 0.53%. And lastly, in year 2023, the ratio is 0.28%, which has declined.
Now, let's discuss the equity multiplier, which measure financial leverage and indicate the proportion of asset financed by equity versus debt. Our equity multiplier has been rising steadily from 8.92 in 2021 to 11.37 in 2023, suggesting an increased reliance on debt financing. While leveraging can amplify return, it also heightens financial risk. Management should closely monitor debt levels, explore equity financing options, and ensure financial stability, especially in uncertain market conditions.
I will be discussing the debt to equity ratio or DER for Bank Muamalat Indonesia, which is an essential financial metric that make sure the banks reliant on the corporate to its equity. This ratio helps determine financial leverage, where it higher DER indicate greatest dependence on borrower fund, while a lower DER reflects stronger financial stability and reduced risk. The formula for calculating DER is the total debt divided by total equity multiplied by 100. Examining the DER trend from 2019 to 2023 for Bank Muamalat Indonesia, a consistent decline can be observed, signifying improved financial health. In 2019, the ratio stood at the 23.5%, which highlighted a high level of debt reliance. By 2020, it dropped to 16.5%, indicated a reduction in liability or an increase in equity. The downward trend continued in 2021, with the DER decreasing to 30.8%, which reflected the impact of financial restructuring. In 2022, the ratio further fell in 12%, suggesting increased capital stability. Finally, in 2023, the DER is 12.83%, demonstrating a well-balanced capital structure with lower financial risk for Bank Muamalat Indonesia. This steady decline in DER over the year showcase strong financial management and a commitment to reducing the dependency. A lower DER not only indicate better financial stability but also enhance investor confidence and long-term sustainability. Company with a lower debt to equity ratio are generally in a better position to withstand financial challenges and seize good opportunity without excessive reliance on internet. I will be discussing the best 3 leverage ratio for Bank Muamalat Indonesia, which is the ratio regulatory make sure designer to accept the best capital adequacy in relation to its total risk exposure. This ratio ensure the bank maintain sufficient capital buffers to absorb potential loser, preventing excessive leverage and reducing financial vulnerability. A higher leverage ratio indicates stronger capitalization and a level risk of financial distress, making it a essential benchmark for financial stability for Bank Muamalat Indonesia. Looking at the velocity leverage ratio from 2019 to 2023 for Bank Muamalat Indonesia, we can see notable inflation. In 2019, the ratio stood at 12.30%, which reflects moderate capital strength. By 2020, it increased to 40.15% level by capital injection improvement by asset quality. The most significant growth occurs in 2031 when the ratio surged to 22.17%, supported by BPKS inflation tightening. The banks continued in 2022, which is 2022 for 0.49%, indicating balance growth alongside business expansion. However, in 2023, the ratio declined slightly to 20.21%, which was attributed to increased risk exposure and shift in sector allocation. The data highlighting the importance of actively managing capital reserves to maintain financial resilience. While the increase to leverage ratio from 2019 to 2022 demonstrates strong capitalization effort. The slight dip in 2023 underscore the need for ongoing monitoring of managed exposure and market conditions, as well as maintaining Basel III leverage ratio not only ensure regulatory compliance but also enhance investor confidence and overall financial system stability. That's all from me.
Assalamualaikum warahmatullahi wabarakatuh. My name is Tanti Vasiliani with Secondary. So we will continue with quick ratio analysis. The quick ratio evaluates a company's liquidity by measuring its ability to pay short-term liability using liquid asset. A quick ratio above 1 is ideal, but for Bank Muamalat has consistently remained below 1 from 2019 to 2023, indicating liquidity challenges. While we see gradual improvement reaching from 0.29 in 2023, it is still insufficient. The lowest point was in 2021 at 0.065, showing critical liquidity issue. The company must focus on improving cash flow management, reducing reliance on inventory, and exploring alternative financing options to mitigate liquidity risk. Next, we analyze the gross profit margin, which measures the percentage of revenue remaining after covering the cost of goods sold. A higher GPM indicates better profitability and cost control. Looking at the trend from 2019 to 2023, we see fluctuation with a significant drop in 2023 to 70.61% from 23.84% in 2022. This signal reduced efficiency possible due to increased production costs of lower revenue. To regain stability, we need to focus on better cost management and efficiency. Moving on to the operating profit margin, which reflects the percentage of revenue left after covering operating expenses. A higher OPM indicates better cost efficiency. From 2019 to 2023, we noticed fluctuation in operational efficiency. The peak was in 2021 at 43.61%, showing excellent cost control. However, a significant decline to 26.91% in 2023 suggests rising costs or lower revenue affecting profitability. To address this, we must optimize cost structure, enhance revenue generation, and improve operational processes.
Assalamualaikum. I am Nur Ashinadah binti Hamid. My metric number is 2023837676. This slide will present the 5-year current ratio for Bank Muamalat Indonesia from 2019 to 2023. In 2019, the bank had a current ratio of 0.52, which is below 1.0, indicating the bank had liquidity issue and might have struggled to meet its short-term obligation. By 2020, the ratio improved to 2.114, showing a significant recovery in the bank liquidity. This suggests the bank took measures to strengthen its financial position and had sufficient short-term assets to cover liability. Okay, we move to 2022 and 2023. The ratio decreased slightly to 2.80 and 2.50. This decline shows that the bank become more efficient in utilizing its assets. While liquidity remains strong, the bank might have operation to reduce excess liquidity and invest thus assets in more profitable opportunity. Overall, we can see a clear trend. Bank Muamalat Indonesia start with liquidity challenge, recover strongly, and then become more efficient in using. We move to net profit margin for Bank Muamalat Indonesia from 2019 and to 2023. By 2020, the bank started to recover, posting a modest net profit of 10 billion rupiah. Though the small, this improvement was a sign of the bank stabilizing through cost cutting and better financial management. In 2021, the bank had a major turnaround, achieving the highest profit in 5 years at 75 billion. This boost was driven by strong financial management, better operational efficiency, and increased revenue from Sharia-compliant products. In 2023, there was a slight recovery with a net profit of 70 billion. While this market an improvement, it was still much lower than the profit in 2021. The slow recovery highlights ongoing financial challenges and the need for better management. In summary, while the bank showed recovery after facing challenges in 2019, it still has work to do in terms of cost management and adopting long-term strategy for sustainable growth. The next slide is present the debt ratio analysis for Bank Muamalat Indonesia from 2019 to 2023. From 2019 to 2022, the debt ratio remains stable at 92%, showing the bank's strong dependence on liability. In 2021, the ratio peaked at 97.23%, the highest in 5 years. This indicating increased financial risk as most assets were financed through debt. By 2022, the ratio dropped to 91.52%, reflect better debt management. However, in 2023, it slightly increased again to 92.21%. In conclusion, while Bank Muamalat Indonesia improved its debt management in 2022, it still relies heavily on debt. Going forward, the bank should focus on reducing liability dependency optimizing asset utilization, and enhancing financial stability to lower the financial risk. In conclusion, Bank Muamalat Indonesia has demonstrated overall financial stability over the past 5 years. While profitability has experienced some fluctuation, the bank capital management, liquidity and debt strategy have to contribute to strengthening its financial position. The positive trend in profitability, even with occasional drop, highlight the bank's ability to navigate financial challenges. Moving forward, the bank should focus on increasing capital reserve, improving its asset management, and enhancing operational efficiency. These areas are crucial for ensuring continued growth. Additionally, embracing digital transformation and staying ahead of regulatory change will help Bank Muamalat Indonesia maintain its competitive in Islamic banking sector. By adopting better strategy and focus on this key area, the bank can continue to grow and retain a strong market position.